Okay, good morning, ladies and gentlemen, and welcome to MacroAce with your host, Tony. I'm also the head financial analyst at FinancialJuice. So, ECB rate decision expected no change for all through the rates. The two rates we'll be focusing on will be the interest rate and the deposit rate. We're also expecting the ECB rate statement. So that will be released at 8:15 a.m. Eastern Time. So what we want to do is go through some of the expectations, what's been said, what are investment banks saying, and what have central bankers said as well. Okay, so with the ECB rate statement and the deposit rate. So the deposit rate is the first rate. The interest is the rate paid by the ECB to banks having a deposit at the central bank. So it's where banks can place excess reserves and earn an interest rate that is usually 100 basis points or a percent below the main refinancing rate, and that usually establishes a floor on the interest rate, since no bank will lend out less money than what it can earn at the deposit facility. Of course, that's a different case. It has been for a very long time now, where the only difference between the deposit rate and the main refinancing rate is about 0.5% for the interest rates differentials, but still quite important, as that's what a lot of central bankers refer to when they're talking about where the rates will peak, or if there's more work that needs to be done. But it is the main refinancing rate that usually is focused on by everyone else. So, carrying on then. So if we keep going on here, so as we've seen that where is the economy at the moment, we need to understand what is the ECB looking at in their run up to their decision. So inflation at 4.3% compared to 5.2%, and core CPI at 4.5 compared to 5.3. The manufacturing PMI data we had this week came in lower than expected at 43 compared to the prior 43.4. Services PMI was at 47.8 compared to 48.7. Consumer confidence slightly down at minus 17.9 compared to minus 17.8. The German IFO business climate data at 86.9 compared to the prior of 85.7. The ZOO economic sentiment at minus 1.1 compared to the prior of minus 11.4. So slightly better outlook provided from the business's point of view in Germany, and also the economist's point of view for the German economy as well. German inflation at 4.5% compared to 6.1%, and the HICP, or the harmonized, which compares the German inflation to the other nations within the Eurozone, was at 4.3% compared to the prior of 6.4%. So inflation continuing to make headways towards the central bank's target of 2%. But the question is whether or not that's enough for the central bank to not have no further need to raise interest rates from now on, with this meeting included, or is there still some lingering members that may say that we need to continue raising rates until they're confident that inflation is going to be headed towards the 2% inflation goal? We'll go through the comments that ECB central bank members have made. So the previous ECB meeting on September 14th, we had the surprise 25 basis point hike to a record high of 4.5%. It wasn't a complete surprise. You did have markets that were starting to price in the expectation of a 25 basis point hike. So when you do see the market reaction that I'll show you, you'd seen that initial whips or initial strength from the euro, and then weakness afterwards. Following that, they said they'd seen inflation. They see inflation at 5.6% compared to the prior forecast of 5.4%. Inflation continues to decline, but is still expected to remain too high for too long. The Governing Council considers that the key ECB interest rates have reached levels that, maintained for sufficiently long duration, will make a substantial contribution to a timely return. So that point being there, the surprise hike that was taken after that initial pop, that headline there had caused the euro to then weaken in turn, marking more or less to what the markets take it as a final rate hike from the ECB. ECB staff slightly revised down the projected path for inflation, excluding food and energy, or the core inflation reads, to an average of 5.1% this year, 2.9% next year, and 2.2% in 25. And they also see GDP slightly weaker at 0.7% compared to the prior forecast of 0.9%. So remember, it's not only the inflation data and how the ECB interprets it that's going to be important. You also have the other added factor of how well the Eurozone economies perform. Now, that's the big headache that the ECB has, is because of there is more or less a fragmentation between how quickly one nation recovers compared to another. And then that makes it more difficult for the ECB to decide to, first of all, when do they decide to stop raising rates? If the last one was the last decision and that was it, to raise rates. The other question is, do they start cutting rates sooner rather than later if the outlook for the Eurozone economy or Eurozone nations turns out to be worse than what the ECB had expected? So those are two of the things that the ECB has to contend with. Now, the latter of the Eurozone economies faltering and there not being fiscal rules put in place for nations to meet their GDP requirements makes the ECB's job more difficult. We'll go into that in a little bit later, but just something to keep in the back of your mind and just be aware of what could cause market movements depending on how dovish or hawkish the ECB might be about the economic outlook for the Eurozone. ECB minutes then, October 12th, a pause. They said that a pause could give rise to speculation that the tightening cycle was over. A solid majority of members expressed support for the 25 basis point rate increase, and the emphasis was placed on the upward revisions to the headline inflation projections for the first 2 years. Long-term sovereign yields had risen across major advanced economies, but the increase had been more muted in economies where there had been negative macroeconomic surprises, such as in the euro area. That statement probably not really holding up that well, considering how the treasury market has acted. And we have seen rising yields in speculation that central banks will hold rates for higher for longer, rather than maybe cutting rates sooner than what the market would have wanted or would have previously speculated on. ECB member views then. So we had Lagarde, who told EU officials on the 24th of October that the battle against inflation is going well, but she did complain that not having an agreement on how to interpret the EU Stability and Growth Pact in time for January, when the rule limiting deficits to 3% of output will be reinstated, is a problem because it risks putting pressure on the monetary policy to do more. So there's either that's more open-ended. It could be either more to do with if you have some countries that are chucking more money in to their own economies compared to others, then it could overinflate that the economy in certain parts of the Eurozone economy that might be doing better than other parts of the Eurozone economy. And that could then lead to higher inflation prints if there's more money being spent than there should be spent. Or there's a flip side to the argument that later on, after the ECB has near enough got to their 2% target for inflation, that because of the fragmentation and because there are no tight fiscal rules put in place, that there might be more support that the central bank might need to do, and then that risks inflation flaring up again and a slight overheating in various parts of the Eurozone economy. The key thing is fragmentation. How strong could that be? And that's what Lagarde was trying to hint at. And there's two ways you can interpret that with the two ways that I've just mentioned. You had McClough, who said that also another thing from Lagarde as well, she said that the fight against, the following day on TV, she said that the fight against inflation isn't over yet. McClough on October 24th said the Middle East crisis is bound to have an impact, but the question is to what extent. Holtzman had said that further shocks may require additional ECB rate hikes. October 16th, you had ECB's Lane, one of the board members, one of the governing board members, who said that we'll keep interest rates high as long as necessary. And then finally, you had ECB's Vassal, who said that spread movements are a reminder to governments that fiscal coordination is necessary. So you've got to think about it. If the treasury market is boosting, if we're seeing a high rise in yields, remember you would have businesses that, or consumers that will be taking out loans that the banks will then might have to charge at a higher rate. And then the ECB would have to step in to try and offset the treasury, to try and keep the treasury market in place and try and keep it under control in order for that to not to happen. So there might be more of a, that's why Lagarde was talking about more of a fiscal unity between the nations in the Eurozone area, because if there isn't, then the treasury market in the Eurozone could get out of hand. And then you also have nations' economies that also get out of hand too, where there's no coordination that happens. So if you watch my risk on risk off trading video, the last one that I did for risk off part 2, then we talked about how the euro isn't seen as a safe haven asset because of the one, fragmentation, two, how it's dealt with recessions in the past and how it had to peg its currency to the Swiss franc in order to shore up some liquidity. Now, I'm not saying that they're going to do that again with the Swiss franc. I think the Swiss have learned their lesson the hard way with that there. But it opens up the possibility of a more muddied picture and a less brighter outlook for the Eurozone economy. ING with a crib sheet, very, very useful as to the kind of things that could come out from the ECB in the rate statement, and what ECB's Lagarde could say as well in the press conference. So if we're looking at the different scenarios that ING presents here, their current base case scenario of what they expect to come out from the ECB in the statement is that core inflation is still resilient, but inflation is coming down. However, there are upside risks for next year and the year after that. Growth outlook as well is also very important, saying that it's seeing as unchanged, and the economy is to remain subdued growth environment. They don't hike interest rates at this meeting, and they remain data dependent. And also about discussing PEP, that they say that discussion about non-interest rate policy tools could also pop up too as well. But if we're looking at the very dovish side of things, okay, that's what we're kind of looking for when we're looking at how to try and trade this and what kind of opportunities could be presented. You're looking at the far end of both arguments, or the dovish side and then the hawkish side. So you can see here with the dovish side is that they may that the medium-term inflation may return to target earlier than previously thought. Usually the medium term is anywhere between 12 months to 18-month time period. Okay, so they say that it may return. One case for the dovish side is that medium-term inflation may return to the 2% target earlier than previously thought. In regards to the rates decision, again, no hike, but peak in rates has likely been hit given high yields. So again, similar to what we've seen with Federal Reserve members talking about the treasury market maybe doing the job enough of tightening credit conditions, you could get that in the ECB rate statement today as well, if they feel that tightening in the treasury, high yields in the treasury market negates the need for the ECB to jump in and continue raising rates. If we look at the flip side, on the very hawkish side, if they do decide to go for another 25 base point hike, but they're data dependent on future decisions, they stress that the rebound of potential economic activity, and that there is a high chance that 2% target will only be hit in 2026. So inflation expectations of when the 2% target would be hit, and also talking about whether the whether the economy itself would have a strong rebound in the future. How does the economic outlook look like for the Eurozone? And then also shortening of PEP reinvestment period as well. So the liquidity, or let's say the money that's being provided to the banks, to other central banks within the Eurozone, could also be cut down much quicker than what was previously anticipated. So the dovish side and the very hawkish side is what we're kind of looking at, ideally as a perfect scenario for either side. But I think usually what we do get is we kind of get a mix of these comments. So you could get the idea that the central bank sees medium inflation returning to target earlier than previously thought, but according to ECB members, that there is still a lot to do, that there is still more work to do with bringing down inflation to the target. And then you might see, but the idea of the very hawkish side in this current scenario seems a bit far off with how ECB members have been kind of talking about the Eurozone economy itself, not being as strong as they would have thought it would be at this point in time. But you have had members that have mentioned that there would still be a need that they're not done with the rate hiking cycle as of yet. So you get a mix of this, which makes it a bit more difficult with the ECB and any central bank rate decision as well. So the bets and expectations then, and sentiment of what we're looking for, what the investment banks are looking at. So Goldman Sachs, they said that despite, there we go. So Goldman Sachs say despite showing the EU economy is stagnating, the rate of inflation is too high for comfort, and the case of cutting rates would be down to material growth downturn that would speed up disinflation and the growth outlook as well. Also, another thing to mention as well, on the 14th of September, post the last interest rate decision, you had money markets that priced in 30% of further ECB hikes. So that's quite a key figure to understand or to take note of, that the markets are expecting no change at this meeting. Anything that goes against market expectations usually leads to more volatility within the markets, whether it be up or down. So in this case, if you were to see that the central bank decided to hike rates going against what the money markets are expecting, okay, then you could see the potential for the euro to see strengthening off of the back of not meeting expectations at all. The last time round we had the ECB rate hike, traders and money markets were starting to price in the expectation of a 25 basis point rate hike. So the initial move, yes, you did see upside movement from the euro, but then after that, it flipped its switch and went towards the downside. So it's already priced in. So and then if we look further as well from ING, they expect the ECB to pause at this meeting after inflation slowed and bond rates spiked and new geopolitical risks emerged. They expect the market reaction to be relatively contained. So not really expecting a whole bunch or a lot from the ECB. Also with rising bond yields as well. So Monday you had US 30-year yield, 30-year that rose to 5.13%, which is the highest since 2007. This is important to understand as to what central bankers might do, because whatever happens in one market could then have a knock-on effect in the other markets, in other nations' treasury markets as well. And we've kind of seen that all over the place, to be honest, where in the US you've seen treasury yields continuing to rise and speculation that rates will stay higher for longer. Same within the Eurozone too, with the Italian bunds and German bunds as well. You've seen yields rising in that area too. So then on October 25th as well, you had German real yields that led the underperformance as money markets adjusted for a higher for longer monetary policy outlook. They also paired their 2024 ECB easing bets by 3 basis points to 71 basis points of easing in 2024, but the traders' main wagers on policy remaining on hold at the Thursday's decision. So again, if the flip is switched and going against market expectations, that's kind of what we're looking for. Otherwise, if it's just a boring monetary policy statement, then there isn't much to look out for. Or there isn't that much you can do in those cases most of the time. So this is the last rate decision that we had seen. So this is about 10 seconds before that on September 14th. So we'll see the initial strengthening from the euro off the back of the rates of the surprise rate hike of 25 basis points on the ECB interest rate, what we've seen there. And if we kind of skip ahead a little bit more, we can see that after that, the market reaction didn't last that long. The initial strengthening that we had seen. So we keep going. Gonna go through what else we had. Okay, well, of course that was the retail sales data and initial jobless claims. But this is how the markets reacted. So because of that, as I said, there was a surprise of the 25 basis point hike being taken. But then the statement itself was more dovish than what markets would have expected. Also, remember there's the sell-off from the expectation of the 25 basis point hike being priced in. That they had seen the reversal on the euro's strength as well. So let's go through the deviations as well. I want to show that there. And let's bring that up. So deviations is quite important to know which market had seen the biggest reaction. If we look at the euro area for the ECB, let's bring this up. So you can see here, not only just covering the ECB data, but we've also got a load of other bits of data too that we cover. And where is it? There we are. Here we go. So this is the initial market reaction that we had seen. So it whipsawed. You can see here on the stock indexes for the FDAX and Stocks 50, you'd seen about 34 tick towards the downside, and so this first figure here shows you the initial movement on the first candle, okay, and then here see after about 10 minutes of trading was what the bracket in the black represents. Going to the end of the candle, you can see after about 10 minutes of trading, it was up by 43 ticks. The figure in the blue brackets represents the move 30 minutes after the economic release or data had come out. You can see it was up by 70 ticks after that. But if we're looking at the currency pairs were very, very mixed. Okay, you didn't see a huge amount of. The only currency pair that had seen the biggest reaction out of everyone else, and by a slim margin, you'd seen the euro yen. It was up. So this was the initial market reaction, right? So you'd seen 32 pips towards the upside, and on the same candle, and then it went down 36.5 pips. And then after about 10 minutes of trading, it was down 46.5 pips. And then after about 30 minutes of trading, it was down by 53.5 pips or so. So that was the market, that was the currency pair that had the biggest reaction, within second place with the Euro New Zealand dollar. If we look at the Euro dollar here, you see the initial market reaction wasn't that strong. And then after about 30 minutes of trading, it was more or less had the same amount of movement as the euro yen, or close enough to it. So the euro yen is what we're going to be looking out for, keeping an eye on. But you can see here that the main reason, so this is the key thing in the deviations and why it's useful for interest rates, is I give you not only the reaction of how the markets performed, but also, and what the deviations were, okay, but also the sentiment for the interest rate decisions. So here, So despite the surprise rate hike, there wasn't really a big surprise as markets were already pricing in a bigger chance of a 25 basis point hike. The ECB said that the Governing Council considers that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to the 2% goal. That's why it's important not just to focus on the figure itself. It's also important, like I said yesterday as well, for the Bank of Canada. Although the Bank of Canada's one was quite boring, there wasn't anything surprising or new. It's important to focus on the rate statement itself too. So, if the rate comes in as expected, but the statement is very hawkish or dovish, that could then flip the market into one direction or the other. Even if there is a 25 basis point hike taken, okay, albeit that is going against the majority of what the market has expected, the statement itself could be very dovish and dampen how strong that bullish reaction could be for the euro. So we have to be able to, first of all, of course, see what the rate is, then understand what the statement is saying or what's being mentioned, to then be able to figure out, okay, is this dovish or bullish overall? Of course, by that time, you might have had, the markets might have already had their reaction. It's difficult. You can either jump on the trade or you don't. But it's better in with rate decisions. I mean, it depends. You can do whatever you want to do, but it's better to kind of take on the more cautious approach, kind of see what the central bank is saying before you then go on to make your decision. Otherwise, you're kind of going in blind. Nobody wants to go in blind. I mean, you can if it's worked for you, perfectly fine. Do that. Nobody's trying to tell you, don't do, nobody's trying to force you to say don't do that. I just recommended to understand what's been said, because if you put on a position and you see a bit of a whip towards the upside, you think it might go on forever, then you might be holding yourself in a position that's not really beneficial to you. But even if you understand what the statement says, right, you might not get where you want to get to, but at least you're more prepared. And that's the whole point of MacroAce, is to prepare yourself as to what could come through from the central bank or a central bank, and what are the different scenarios that could be presented as well. So if I just bring it up on the Euro Japanese yen. Oh, I've got to close that. Hold on. Okay, so let's see. We've got about a minute left now. So 1 minute to or less than a minute to the release. Let's see how it performs. Let's get our TICKSTRIKE up and running as well. And what I'll do is I'll try and read through the statement myself and get a better understanding of what's going on. Okay, all right. Got our tickers up and ready. Okay, 10 seconds. Okay, no change as expected for both the ECB interest rate and the deposit rate. Statement. So also keep an eye on the markets here. No real reaction from the euro as of yet. So let's have a look at what the statement has said. Future decisions will ensure that its policy rates will be set at sufficiently restrictive levels for as long as necessary. Just seeing the Eurobonds here, seeing bond price, remember, seeing a move towards the upside, with the DAX seeing some strengthening here too. Right, let's get through the rest of the statement. Interest rates on the main refinancing corporation rates. Yeah. Just trying to see if there's anything new here. They're determined to ensure that inflation returns to its 2% medium-term inflation target in a timely manner. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong. Key point, past interest rate increases have continued to be transmitted forcefully into financing conditions. They're going to continue pep reinvestments until the end of 2024. They follow a data-dependent approach. Nothing here. Okay, so as said, Europe's stock 600 pairing some losses after the ECB decision, last down about 0.8%, and the euro extending its loss against the dollar after the rate decision, last down 0.3%. So nothing. Yeah, there wasn't anything outstanding from it, to be honest. If we're looking at it. Okay, let's do some measurements here anyway. See what else has been said. How the markets reacted, should I say? Okay, so about 11.5 pips down on the euro yen. It's quite a. So it's a boring release ish. Better than the Bank of Canada's rate decision though, what we'd seen yesterday, or more of a reaction. The Bank of Canada, on the ECB than the Bank of Canada. That's the Eurobonds. Look at the DAX. Okay. 27. Stocks. Right. Like here. Okay. Y, Euro USD. Okay. So overall, a more or less muted reaction if you're looking at it this way here. So you can see here, Euro reversing its, or trying to reverse its dip that it made. Okay. Yeah. Not a lot. Okay, so just to summarize that, there wasn't anything crazy or outstanding from the ECB. They did say that interest rate increases continue to be transmitted forcefully into financial conditions. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong. Other than that, nothing new. Well, those weren't even new themselves either. So, yeah, there wasn't anything else that was interesting. All right. So that concludes. Well, if you like that video, if you like the stream so far, don't forget to like the video, subscribe to the channel, get the word out there. If you found the information useful. Also, with as said, with the deviations sheet that I had shown you earlier, let me bring it up again for you. So that is, so if you're a subscriber to the MacroAce mailing list, then you get this completely free. Okay, and as I said, you get to have a look at the different economic releases that we have covered or cover. Some of the releases we don't cover anymore because there isn't that much of a strong reaction to them, or consistently strong reaction. It's kind of all over the place. That's what we cover here. Again, as I said, you can see the strength or how strong the market reaction has been to economic releases. Okay, and then you're able to look at the deviations and then work and then kind of make your own sort of strategy as to what you could expect yourself for those economic releases. And for the interest rate decisions, like the FOMC for next week, you can also, not only do you get the market reactions of but you also get the sentiment that is added on the side too. You get to see what was said, or what would have caused the market to move. Of course, interest rates are more complicated because you have a statement that's released with it. It's important to kind of go through before you make a decision whether to jump onto a trade or not. And in this case, today, there wasn't that much. So it was boring. Nothing out of the blue. So that what you can do if you would like to get access to the deviations Google Sheet, all you got to do is sign up to the MacroAce main list here. Alongside the deviations, again, as I said, that's completely free. It's all completely free to be able to look at the deviations sheet. Alongside with the main list, so when you subscribe to it, every Monday morning, you get an email from myself detailing what to expect for the week ahead for Europe, the US, and Asia session. It's very short. There's not a lot of detail that's kind of put into it. It's short and sweet. It acts as more of a refresher for what has happened over the weekend, and then what is expected for the week ahead. You get the link to the deviations Google Sheet, and also the link to the upcoming live streams for the week ahead as well. So that's what's included. Again, it's not fancy with a load of charts and graphs. It's just a little bit of text detailing what to expect for the week ahead, with a link to the Google Sheet or the deviations sheet as well, and the live streams that are going to be coming up for the week ahead. So this is quite important, actually. Headline. So spread between Italy and Germany, German 10-year bond yields narrows 199 basis points after the ECB decision from 202 basis points previously. Okay, it's not by much, but still quite important for the bond yield for the spread to be closer together rather than so far apart. Okay, so that's that there. That's the link for the MacroAce main list. Also with FinancialJuice, here is you get FinancialJuice provides a live voice and text service. So you would have, if you're already subscribed to, if you're already a member of FinancialJuice, you would have heard Ben on the microphone doing the ECB rate decision. What Ben? But yeah, so here we have our live voice feed here. Again, so what we do is we provide live voice and text service in real time of what's going on around the world, what's going on in the markets, what are central bankers saying, or what are politicians saying, all live in real time in one place. So here you have your voice feed there, and you can see here in the center we have our news feed of text headlines that come through with important bits of news that we focus on, and then the left hand side you have the calendar or the economic calendar as well, so you can keep, as I said, keep up to date with everything that you need to keep up to date with all in one place. And here you can see we have called the need to know market risk, so anything that's going to potentially affect your day ahead or has already affected the markets already will be popped in there as well for you to keep an eye out for. All right, so that's FinancialJuice. So now, if you would like to subscribe to, sign up to FinancialJuice, you can do that through here, through this link. There we go. Yeah, we got GDP in about 5 minutes too. The prelim data for the US. I mean, I'm probably we'll have a look at it anyway. Why not? Since we're here. Let's bring the dollar yen. Oops. So yeah, so if you like to subscribe to FinancialJuice, I've popped in the link there. It's completely free. Now, the free version of FinancialJuice or the light version of FinancialJuice, it is a delayed feed, and you also get adverts that pop up. But if it's the first time that you're playing, or if first time seeing a live voice and text feed, get used to it first. The idea of how it can add to your trading experience and how you could add it in as a tool. And once you feel confident with working with using FinancialJuice, then what we can do is you can go to the button that'll be here in the top left. Hopefully you can see where I'm kind of hovering over, where it says FinancialJuice Pro. Actually, let me just make that a bigger screen. So here in the top left hand side, it'll say Go Pro. You can click that button there, and then you can subscribe to whichever subscription that you want for the Pro version of FinancialJuice, which has no adverts that play. It's all live in real time. You also get access to the news desk as well, which is us, to be able to ask what to expect, to be able to ask what's going on in the markets, what cause the markets to move, or if there is any speaker that's expected to speak today, or and so on and so on. That's what Pro users get access to. And if you do decide to jump to the Pro version straight away without going to the live version, get an account on FinancialJuice first with the live version. Okay, then go to email, verify your account, go back to the FinancialJuice feed, click on Go Pro, select your subscription. Once you've selected your subscription, go back to and you've paid for it, go back to the news feed, log out, and then log back in, and that will act as the verification process. And then you should see this lovely screen that I see here. Okay, and then finally with TICKSTRIKE. So TICKSTRIKE, if you've never come across it before, what it does is it allows you to listen to order flow, or in other words, it tells you how strong the buying or selling momentum is within the markets. That's in forex, stocks, futures, cryptos, ETFs and ETNs, and your internals as well. So if we're looking at the VIX or the ADD, it also gives you a gauge as to how strong or how strong the buying or selling momentum is. So this box here, which you hopefully you can see, is the ticker box. Now the ticker box, what it is, you can see here. If we're looking at the FDAX here, or the DAX, this shows you how strong the buying or selling momentum is. A plus figure shows you the buying momentum, and a negative figure shows you the selling momentum. The number is based off the slider that we have here. This is the sensitivity gauge, going from 1 to 15. 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling momentum, then TICKSTRIKE will give you a visual and audio alert to that, or you can chop between either visual or audio. Okay, and you can also change the level of sensitivity to whatever you want it to be. Now remember, the higher you go, the less sensitive the ticker becomes to the market reactions. So in another way to think about it, the higher the sensitivity if you put the sensitivity level all the way to 15, only when there's a big amount of buying or selling momentum that occurs will TICKSTRIKE give you that alert. Okay, and of course here on the Pro version, you can kind of chop and change between whatever sensitivity you want, whatever works for you in your trading. This is made for day traders, this tool here with TICKSTRIKE. And also for those who like to scalp the markets or looking for that extra amount of spice in their life. This lightning bolt here on TICKSTRIKE is uber sensitive. So 1 is the most sensitive to market reactions. So GDP data, 4.9%, higher than the forecast of 4.5%. Did see the dollar see some strength there. Let's bring up the S&P. Okay, so yeah, did see a bit of a whip down initially. Let's look at some of the other areas too. Durable goods was higher than expected. GDP price index at 3.5%. 3.5%, higher than the forecast of 1.7%. If we're looking at the core PCE prices advance at 2.4%, lower than the forecast of 2.5%. Let's see what else we got here. Jobless claims at 210k, higher than the forecast of 207k. Okay, so you did see an initial reaction off the back of that much better than expected GDP data for the advanced data for the US. Well done, USA. All right. Okay, so you've seen the initial whipsaw for that. So the question is then, what does that mean? So if the data was stronger than expected, first of all, you have the sentiment of whether the Fed will continue raising rates, or keep raising rates like where they are, or maybe continue raising rates. And then you have the stock market you have the indexes taking it in a way that if the US economy is still performing better than what was expected, then that might be bullish for the stock market later on, and for the US economy as well, that they can weather the high level of interest rates that have been set by the Federal Reserve. Just a little quick analysis there, but yeah, don't like it. It's dicey. Okay, so going back to the lightning bolt here on TICKSTRIKE. So the lightning bolt, as said, the lightning bolt represents 15 levels below 1. So 1 is the most sensitive to market reactions. The lightning bolt means you're going to minus 15, okay, or another 15 levels below 1. So it's uber sensitive. So if you're scalping the markets, then that's what you want to. That's again another tool to add to your arsenal to be able to look at. So any little bit of buying or selling, or every single little bit, okay, you can kind of see here on the DAX. You can see that the TICKSTRIKE, the ticker there, is going to represent that buying or selling momentum. And again, you can chop and change to whatever you want it to be. I don't get on with it with the lightning bolt. It's too hectic for me. There's a lot going on. But if it works, if, as I said, if you're scalping the markets for those opportunities, little bits here and there, again, it's another tool to add to your arsenal. All right, so so let me put in the link for that there, TICKSTRIKE there, and that will basically conclude the live stream. So thank you very much for joining me live for the ECB rate decision and a little bit of GDP data. But also remember, next week we have not only the Fed rate decision on the Wednesday, but also the Bank of England on the Thursday with their rate decision too. So still going to be, we're not out of the woods yet. Still got quite a bit to go towards the end of the year, and yeah, we'll see what happens then. But as said, if you subscribe to the mailing list now, you'll get an email Monday with a link to the deviations Google Sheet and a little summary of what to expect for the week ahead. Again, that's not fancy. So if you're expecting charts and graphs, then maybe it's not for you. But if you like a little refresher here and there, then maybe it is. All right. Thank you very much. Thank you very much, ladies and gentlemen. Enjoy the rest of your day, and I will see you next week.